Hey everyone, Eric here from Safeguard. Today I want to walk you through what exactly a Roth conversion is and why it might be valuable to your retirement. I will say that I think Roth conversions right now in today's tax environment is one of the most powerful tax strategies you can be using. I would say for every 10 retirement plans that I build, Roth conversions are a part of, I would say, at least 9 of those plans. And so it's something that's widely used, has a huge impact, and something you should really consider using for your situation. So let's walk through some basics today. And before I talk through what exactly a Roth conversion is, let's step back a second and just talk through what type of retirement accounts are involved in a Roth conversion, okay? So the two types of accounts that are involved with a Roth conversion are a tax-deferred account and a Roth IRA, okay? What is a tax-deferred account? Well, basically, accounts in this category would be like traditional IRAs, 401ks, 403bs, 457s. And essentially, when you put money into these accounts, when you contribute to these accounts, you get a tax break in that given year, okay? That money then grows tax-deferred. That's how it gets its name. And then when you pull money out eventually, when you withdraw that money, you then pay taxes. So essentially, you're deferring taxes until you take that money out and you need that money. Roth conversions essentially, or Roth IRAs, I should say, essentially work the opposite way. Okay, you pay taxes right away on the contribution, but then that money grows tax-free and you can then withdraw it tax-free as well. So essentially what a Roth conversion is, very simplistically, is taking money from a tax-deferred account, paying taxes in a given year, and converting it to a Roth, okay? So what might this look like? Let's say that you have a traditional 401k. It's got $1.2 million into it. And in 2021, this year, you're going to convert $40,000 from that traditional 401k to a Roth IRA. Okay? Well, you're going to pay taxes in this given year. Let's say your marginal tax bracket is 22%. So of that $40,000 conversion, you're going to owe $8,800. Okay, now, depending on your age, we'll talk about this in a sec, those taxes can be paid right out of that conversion, or the taxes can be paid out of savings, out of a taxable account, and whatnot. You'll also obviously owe estate tax on that conversion as well. But then that $40,000 is converted into a Roth. Okay, the reason I have a padlock on that converted Roth is because you can't access that money right away. You have to wait 5 years, and we'll talk about what this 5-year rule around Roth conversion is in a second, okay? But let's just quick talk about some broad strokes around a Roth conversion, okay? So why would you do a Roth conversion? The only reason that you would perform a Roth conversion is because you can pay less in taxes now to avoid paying higher taxes or higher expenses later. Okay, that's the only reason Roth conversions make sense. If you can pay lower taxes now and avoid paying higher taxes later. Now, I have an asterisk on this point because this is where most mistakes happen. And the reason I have an asterisk here is because I find that most people aren't accurately assessing their future tax rates, their future tax liabilities. Okay, and so towards the end of this video, we'll talk about how you can build a forward-looking tax plan in order to accurately assess if a Roth conversion makes sense. But just broadly speaking, it makes sense when you can pay less in taxes now to avoid paying more in taxes and expenses later. Okay, the amazing part about Roth conversions, why I think it's such a powerful loophole for retirees, is it's available to everyone regardless of income and age. Okay, so for instance, if you were to contribute to a Roth, there is an income limit that if you make a certain amount of money, you can no longer contribute to a Roth. Interestingly enough, though, you can convert from a tax-deferred account into a Roth, whether you make $50,000 a year or whether you make $5 million a year. Okay, so it's available to everyone regardless of income and age. Now, age does play a factor into how you're going to pay taxes on that conversion, however. Okay, so if you do a Roth conversion and you're less than 59 and a half, you essentially to keep the Roth conversion powerful as a powerful tax strategy, you essentially have to pay the taxes of that conversion out of pocket. Okay, you can't pay it from the Roth conversion because under 59 and a half, you'll owe a 10% early withdrawal penalty. Because essentially what you would be doing is you'd be converting a set amount, but you'd be taking from that conversion, withdrawing from that conversion right away in order to pay taxes. Okay, so that doesn't work. It's not allowed, essentially. Okay, and so over 59.5, you can pay taxes. Now, again, not necessarily paying them out of the conversion per se. What that would look like in that previous example is that over 59.5, you can have free withdrawals from your retirement accounts. So if you were converting from your traditional 401k, okay, you would essentially convert in the amount of what would that be? 31,200, okay, and then you would withdraw the 8,800 amount to equal that $40,000 conversion, but the 8,800 would go to taxes. Okay, so over 59.5, you can essentially just take from your retirement accounts in order to pay that conversion, essentially taking the taxes from that conversion, if that makes sense. Okay, so let's talk through some Roth conversion risks that you're going to make sure you want to avoid. Okay, in 2017, the Tax Cuts and Jobs Act was passed. It ended up lowering tax rates across the board, which was a largely positive thing. That's why Roth conversions are so valuable right now. However, there was a key part of the Roth conversion rule set that was eliminated, and this was Roth recharacterization. Okay, basically what Roth recharacterization was is that if you made a IRA to Roth conversion, okay, and you ended up converting too much, you could essentially reverse that. You could recharacterize that conversion. Okay, so let's say that in 2015, you made that same, let's say at the beginning of the year, you converted $50,000. But by the end of the year, you realize you only should have converted $40,000. Well, you can essentially recharacterize 10,000 of that $50,000 conversion to get back to that $40,000 target. Well, the Tax Cuts and Jobs Act essentially eliminated this. Okay, and so there's no more do-overs, there's no more mulligans, there's no more recharacterization. So the amount that you convert has to stay as a conversion. And so this is why I have an asterisk down there. Make sure you're using experienced help when performing a Roth conversion, because the elimination of this recharacterization kind of creates a situation where you want to make sure you're doing the exact amount of this Roth conversion that you ultimately want. Again, because you don't have that do-over. Okay, so if you're, let's say 63, you're on Affordable Care Act, you end up converting too much, causes you to lose a subsidy, you're just out of that subsidy. Okay, and so I would say even if you're working with an advisor and that advisor has been in the industry for 20, 30 years, they may have never done a Roth conversion. Okay, so make sure you're using someone that is experienced with Roth conversions that can make sure they walk you through it properly. The second risk is called the 5-year holding rule, and this is different than the 5-year contribution rule that most of us know about with Roths. Okay, basically the 5-year holding rule is that when you make a Roth conversion, you cannot use that given Roth conversion for 5 years. And each conversion that you perform has a different clock that resets. Okay, so in year one, 2021, we do a conversion. We cannot touch that amount until 2026. Same thing for conversion in 2022. We can't touch it until 2027, and so on. So don't perform a Roth conversion this year, assuming you can tap that money next year. Essentially, you're not allowed. Okay, and so once again, as we're planning through retirement and coordinating our conversions with our investment allocations, we need to be making sure that we're performing a Roth conversion with this 5-year rule in mind. There are a few horror stories that we have, people forgetting about this 5-year rule, and it ended up not being a great situation. So these are the two major risks that you need to be considering. And again, I recommend using experienced help when performing a Roth conversion. Okay, what type of accounts can be converted? Basically, any tax-deferred account can be converted. Now, I just created a quick list from memory, so I might have missed a tax-deferred account or two. Two most common for Roth conversions will be a traditional IRA and a traditional 401k. Okay, but you can also convert from a SEP, a simple, 403b, 457, thrift savings plan. Most annuities you can also perform a conversion in as well if you end up having an annuity. Solo 401ks, etc. So basically any tax-deferred account, just about, you can do a Roth conversion in. Certain 401ks allow you to do the conversion right inside of that 401k. Other 401ks won't allow that, and so you need to roll that money out. Okay. Let's go through a quick example of when and why a Roth conversion might make sense. And again, always remember that we're converting today in order to pay less in taxes in the future or less in expenses in the future. And so this is something, the chart on the screen right now is a chart that shows what's called the Social Security tax torpedo. Okay, we've done a ton of trainings on this YouTube channel around the tax torpedo. Click the button above if you want to learn a little bit more about this torpedo. But essentially it's created when you're on Social Security, the amount that you withdraw from your retirement accounts will determine how much of your Social Security benefit is taxed. So the more that you withdraw, the more taxes you are going to owe on Social Security. And so this creates a situation where as you're withdrawing money from your IRAs, you're taxed on the IRA, but you're also taxed on Social Security, essentially creating a double taxation. So on the screen right now, you see this red line is essentially the tax brackets that are created because of the Social Security tax torpedo. Essentially across the board, it raises taxes by 50 to 85% until your Social Security benefit is fully taxable. And so we see in the most extreme part of this Social Security tax torpedo, you're taxed at 40.7%. And so let's say that you're in the final years of working. Your marginal tax rate is 22%. And we estimate that when you're in retirement on Social Security, you're going to fall right in here, right in the middle of this, the most violent part of the tax torpedo, taxed at 40.7% for here, and then taxed at 22.2% here. Now, most people would say it would never make sense to convert while still working because supposedly your taxes are supposed to be higher while working and lower in retirement. Now, we just debunked that myth, and again, you can watch that training in the link above. But basically, you're taxed at 22%, but we're estimating in retirement that you're going to be taxed at 40.7 and 22.2%. Okay, well, wouldn't it make sense to convert while still working at 22% in order to avoid 22.2 and 40.7? Now, obviously it does. Well, this is exactly where a Roth conversion comes into play. Okay, now there's a ton of other hurdles that can raise your tax rate in retirement, such as RMDs, such as income-related Medicare adjustments, such as Obamacare subsidies and whatnot. So there's all these different hurdles that can raise your taxes, raise your expenses in retirement. This is essentially where Roth conversions come into play. Converting now in order to not be taxed later, in order to save on taxes later. Now, how should you know, and I'm just going to move my head out of the way here. How will you know if you should convert? Okay? And the way to know is something called a forward-looking tax plan. Okay? And if you're watching this video and after explaining a forward-looking tax plan, you don't feel like you have one, this is the number one action step that you can take from this video. Find an advisor that can build you a forward-looking tax plan. It will be the most powerful thing in your retirement. So, what is a forward-looking tax plan? Well, most people in retirement tax plan the same way they did while they were working. At the end of the year, they take a shoebox full of receipts into their CPA and they say, what can you save me? Okay. Well, that might be fine while you're working, but when you're in retirement, this is the most destructive way to do taxes. Okay. Instead, you want a forward-looking tax plan that essentially not only lays out your estimated tax rate in the first year of retirement, but also year 10, 20, 30, and everywhere in between. Okay, because again, there are different hurdles that will show up throughout retirement, such as the Social Security tax torpedo, such as Affordable Care Act subsidies, income-related Medicare adjustments, RMDs. Okay, if you eventually want to pass money on to the next generation, okay, you need to know these tax rates. And the only way to do so is through a forward-looking tax plan. And here's just a snapshot of a chart that comes from the forward-looking tax plans that we build. But basically it shows this person's tax rate in the first couple of years of retirement, but also throughout retirement. And these green bars here are RMDs, required minimum distributions. They're required to take them at 72. And so notice at the beginning of retirement, this person is in the 12% bracket, okay, or just below the 12% bracket here, okay? But notice as they move through retirement, they're going to be taxed at 22% in this bracket and then 24% as well. And so this is a situation where at the beginning of this person's retirement, they're probably feeling great, okay? In this situation, they're actually in the 10% bracket. But notice when RMDs start, they're going to be pushed into the 22 and the 24% bracket. So this is where a Roth conversion can make sense. Converting in these early years here in order to minimize these RMDs later. At the very least, they might be able to completely avoid the 24% bracket. Depending on how big of a conversion they do, they might even be able to avoid some of the 22% tax as well. And notice these brackets are changing through time, again, because there are tax law changes through time as well. When somebody passes away, that's something called the survivorship penalty. Okay, they're going to be subject to a different tax system as well. And so again, this is why it's so important to have a forward-looking tax plan where you know not only in the first couple of years what my tax rate's going to be, but also my estimation for the following years as well. So we can make and assess a Roth conversion properly, knowing that if I pay at 22% now to avoid 24%, 28% later, that makes sense, okay? So hopefully this was educational, kind of gave you a little bit more background on a Roth conversion. They're becoming increasingly more popular. Many people should have been doing a Roth conversion, essentially since the Tax Cuts and Jobs Act was put into place in 2018. So have you been implementing Roth conversions in that time? And are you implementing Roth conversions as this Tax Cuts and Jobs Act window closes in 2026? Okay. Always remember, you don't need more money. You need a better plan. You need a forward-looking tax plan that can accurately assess if a Roth conversion makes sense in your situation. If you're here for the first time or you're someone who's watched a few of our videos, don't forget to hit the subscribe button. It helps us out. It will help you see future videos we post weekly. Thanks for watching. Let me know if you have any questions below. Have a great rest of the day.